So here's how I bailed out Bank of America. So in 2007, a lot of you heard about the crisis that we had, the real estate crisis, which was primarily residential. But let me show you what happened on the commercial side. So things peaked, as we know, in about 2007. So about 2010, Ross and I, my partner, found a 680-unit project that was owned by Bank of America. Now, obviously, they had lent on this project and had taken it back. So banks aren't supposed to own real estate, but they do in crisis. And so that's called the REO department, or the real estate O department. That's not what they're in business for. So we went to Bank of America and we negotiated about a $21 million loan. And this property had a lot of problems. And we ended up buying it and putting about $7.5 million of equity in for a total purchase price of $28.4 million on July 18th, 2011. So a lot of people would ask, why would I buy directly from Bank of America? For lots of reasons. Number one, they had nobody to sell this to. This property was already listed. The property was 50% vacant, had a lot of deferred maintenance from the prior owner, and it was just sitting on their books, and they couldn't sell it. So here's a summary of the property when we found it back in late 2010 before we bought it. It was bank-owned, so the bank actually had loaned $26 million on the project, which means that it was probably worth in the mid-30s to high 30s at some point. So as you know, banks don't loan 100% of the value. So the bank was sitting with $26 million loan on their books. So the first thing that Ross and I had to do was negotiate this loan down if we felt that needed to happen. The second thing is that this property was 50% vacant, which means it had severe negative cash flow, and it had $5 or $6 million in deferred maintenance. And of course, at this point, this was just from walking around. But we knew that there were lots of vacant units that it needed lots of money and a lot of exterior problems as well. And it was listed at about $28 million. So when you're looking at a listing at this point, you're looking at the $28 million plus the negative cash flow, plus the negative deferred maintenance, and all of those things calculate to the whole purchase price. But this is what it was listed when we first found it. So if you're working for Bank of America, you have a loan for $26 million and you're listing it for $28 million, hoping that somebody will come and pay this price and assume all the extra costs so that they don't have to write down the loan and it's not negative to their individual shareholders. So the first thing that you do when you buy a toxic real estate asset like that, no matter who owns it, you have to figure out where all the cash is going to go, because that's all part of the original purchase price or the value or the basis. All of that is one big number. The loan, the equity, the deferred maintenance, and of course, the negative cash flow. That's all negative. That all has to be calculated into the total purchase price. So the first thing that we did is we walked all 340 units, which took about a week, and we classified them into A, B, and C. So A were units that we could turn in 30 days. B's were units that were 30 to 90 days, and C's were real problems, 90 days plus, because we had what we call fire, flood, and blood. There had been a lot of things that had happened at this property, literally from floods to fires that we had to fix. Another thing that we found is that of the 340 units that were occupied, only about 200 of them were actually paying on time. So in the first 6 months, when we started to enforce the rules and just said, hey, thanks for living here, will you pay? They said no. And so we had about another 100 people move out just when we started to apply better management. We realized that we had over $6 million of deferred maintenance on the inside and the outside. And I'm talking about the paint, the roofs, and all the interiors. Some of these units were in really, really bad condition. One thing I want to stress here, this property is in an excellent neighborhood, very close to USAA, a huge insurance company that employs over 15,000 people. So this neighborhood is nice. The area has great employment, yet this property inside of a great neighborhood was horribly managed. So that was a big reason why we bought it. We calculated about a 2-year turnaround, and we realized that right out of the gate, because as you're catching a falling knife, you have about $1 million in negative cash flow annually in this project. So as you consider all of these things, one of the biggest issues is, what is all this going to cost, and how much money do I need to raise in order to fix it? Now, at this point, Bank of America is not going to just sell this property to anybody. They need to make sure that you have the right team, the right experience, and you've been here before. So this was a big piece as they were trying to figure out who to sell it to. The most interesting thing is this property is not financeable. So there's no one on this planet that is going to finance this project other than Bank of America because they already own it. So then we had to decide, what are we willing to pay in order to fix this project? So here are the numbers. But the first thing that we did is we had to decide what we thought the property could be worth when it was fully stabilized and in really good condition. And we decided internally that we thought that number was right around $40 million. The way to calculate that $40 million is simply to add up the rents and add up the expenses and figure out what the net operating income should be if it was fully stabilized. And we decided that it should be about $2.4 million of NOI. It's important to understand that $2.4 million in NOI was our target and what we thought we were going to hit before we bought the property. So we negotiated the $26 million loan that was on the Bank of America books down to 20.9. That means that Bank of America took a write-down of $5.1 million on just this loan. And then we infused $7.5 million in equity to fix what we thought at the time was about $5 to $6 million in deferred maintenance, plus the $1 million in negative cash flow. And I was on a very strict time frame of 2 years because I knew if I wasn't able to fix this project in 2 years, I was not going to have raised enough money and I was going to run out of capital. So in mid-2013, we actually broke even. And what that means is that income is covering the debt and the expenses. At that point, we're no longer negative. When you buy a property like this that's so capital intensive and negative cash flow, you start off with a certain amount of money, and at some point, that money's gone. So it's a race against the clock, and luckily, we broke even at about 14 months. So that would have been about mid-2012. But at this point, now we're barely stabilized. Now there's another strategy to actually reduce expenses even further and bring rents to market, because you don't want to do that when you're first buying something that's so broken. So that's what we focused on in 2013, was fine-tuning the NOI, or net operating income, to get it to $2.4 million. So we ended up doing that in late 2013, and then we brought that to the bank and we got an appraisal, and $2.4 million is the number that we did end up hitting at a 6 cap, equated to about a $40 million value. So now, because the property stabilized, the new lender, which happened to be Wells Fargo, gave us a $40 million value and a $33 million loan against the $40 million value. Now that's about 70% loan to value. So now let me walk you through the cash out refi, which is tax-free, of course, because this is debt. It's not a sale. So we took the $33 million new loan. We pay off the $20.9 million loan, which happened to be the original bank and owner of the property. We pay off that debt that we owe them. Plus, we pay off the $7.5 million in equity that we raised from our investors. Now, this is a return of capital. It's not profit at this point. But those two together is $28.4 million. And we had $6.6 million of additional equity that we were able to distribute. So just in a matter of a little over 3 years, we were able to fix the project, stabilize the project, grow the value to $40 million, get new debt, pay off everyone that had money in this deal from the beginning, and now we were what we would call infinite. So this is an infinite return. At this point, the investors that gave us the money in the beginning were completely out of the deal, but they're still investors in the deal. We just don't have any more capital of theirs in this deal. So this is what makes my partnership with Ross and a lot of other people very different. We like to hold these projects and not pay big capital gains, because we could, of course, sold it for $40 million and, of course, gotten another $7 million and distributed it to the investors, but then we would have had to find another project like this again. So because we're long-term hold guys, We just decided to keep this property and manage it the best that we can for the next several years. And in 2021, we took this property back to the bank and we had grown our net operating income, which is just income minus expenses, to $3.6 million. So that was over about a 7 or 8 year period. Using the exact same math, using a 6 cap, it equates to about a $60 million value. Now, as you guys know, just like we did before, in 2014, we decided to refinance again. So we took this property with a $3.6 million NOI to the bank and we refinanced and they gave us a $40 million loan. So we take the $40 million loan, we pay off the $33 million loan, and of course we have another $7 million to distribute back to the investors. To summarize, if you were an investor, you got your $7.5 million back that you originally gave us, plus another $6.6 million in distribution, plus another $7 million in distribution, not including any of the cash flow of this property as it was generating each and every quarter. So we still own this property today, and we're in the process of renovating many of these units, which of course is going to command a higher market rent, which of course is going to grow our NOI again even higher when we're done. So the goal would be, after we renovate the property, we'll go back and do another cash out refinance. The one big note about that is now the rates have gone up in the last 2 years. It'll probably be a little bit longer, but who cares? Because the investors are very happy with the quarterly cash flow that's kicking out from this property today. And of course, we have a big long-term plan. So the reason I went through this entire example for you is to show you the lag between when banks first start to see stress and when you might be wanting to look at buying. So using the exact same time frames from the earlier slide, you can see in March of 2022 is when I believe things peaked. Now, why would I pick March of 2022? One, because I'm actively buying projects, and I went back and looked at what prices were during that time. Since then, they've come down 20 to 30%. Also, this is when the Fed first started to raise interest rates. As you know, inflation went up to about 9.1% in June of 2022, and things were out of control. The Fed just kept raising rates, which affected real estate prices. So that was almost 2 years ago when it peaked. But of course, what happens, it takes the sellers a little while to realize that the prices that they used to have in the rearview mirror back here are not the prices that people are willing to pay. And so we're starting to now see prices go down slowly over time. Cap rates go up slowly over time. And of course, interest rates are still at 5, 6, or 7%. So where are we today? We're going to see some of the apartment supply hit the market this year and next year, and that's going to add to the supply, which is going to increase vacancy, lower occupancy, increase concessions, and of course, we're challenged with rising expenses. So the apartment market specifically is going through a rough time for the next 2 years. However, about mid to late 2025, this is when you're going to start to see some of the wheels come off of these projects, because most of these folks don't have the capital that's needed in order to keep these projects long-term, and they're going to be looking for exits because they've already cash called a lot of their investors, and a lot of them are out of money. So I would anticipate that this is the year that you need to start getting your team, your equity, and your debt together and start looking for projects as they hit here. And you can too, because I always like to say, you make your money when you buy. And the best person to buy from is the bank when they're in a very bad position. So if you guys want to prepare for one of the biggest financial events that's happened in the last couple decades, the period from here to here, check out my video.